And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. I'm your host, Lance Roberts, and welcome here. It's Thursday, second best day of the week. Michael Leibowitz will join us today, of course, as usual on Thursday to talk a little bit about liquidity. We've had lots of Fed speakers out this week, and of course, economic data was a bit bad yesterday, which sent yields lower. Stock markets did okay because, well, if you got bad economic data, that's good for Fed rate cuts. Doesn't matter what that means for actual earnings, but there you go. Again, this is the problem with the markets that we've been in for a while, is that we no longer really look at fundamentals. It was very interesting. I posted a chart yesterday of Nvidia and Cisco going back to kind of compare. It's an analog of the two stocks going back to 1999, 2000. And back in 1999, Cisco owned 50% of the router market. Everybody believed that at that point, Cisco would dominate the entire world and their earnings would just go to the moon and they would always have a 50% margin on that. Well, Nvidia is a 75% market share with a 75% margin. Everybody just assumes that's going to continue forever. And that's fine, right? I mean, that's what you get. But see, earnings are a function of economic growth. And right now, the U.S. economy is vastly decoupled from the rest of the world. If you take a look at economic forecasts for the U.S., we've got economists ratcheting up the growth this year for the U.S. economy. But if you take a look at the global economy, the rest of the world, right, that economic growth rate is continuing to decline. Well, that can't be the case because we export goods to other countries. So part of our GDP calculation is what we call net export. So that's imports minus exports. So because we export goods and services. So when we export stuff, we get money back for that, which is part of our GDP calculation. So if the rest of the world is consuming less, that impacts our economy. So we can't stay decoupled forever. Now, of course, this decoupling is right now is a function of massive deficit spending. Right now, we're up against the clock for a government shutdown, another government shutdown. We've been doing this for 13 years now. We just can't seem to pass a budget anymore, so we do these continuing resolutions. And so we're going to pass another $460 billion that'll get us all the way through March. And then we're going to be right back into this again, have to pass another set of bills to continue to keep the government open. But this is the funny thing, right? We pass a $1.5 trillion spending bill, in October to fund the year, and we don't ever make it the year, right? Because we're spending too much money. But the Inflation Reduction Act, the CHIPS Act, all this spending is what's giving us this economic boost, which of course ultimately is unsustainable. We can't keep running wartime deficits when we're not at a war, right? So we're running the biggest deficit at a time where we don't have a financial crisis, we don't have a recession, we're not in a war to speak of, and we've got this massive deficit. So again, that's just not sustainable long term, but that's what's fueling the economic activity we have in the economy right now. And this is also why you have such good economic data in terms of GDP growth and those type of things, but yet the rest of the country is very down, of course, on the economy. Now, this is going to be very interesting. Tonight is the State of the Union address. So Joe Biden will address the nation about the State of the Union. And this is going to be interesting because, again, there's a very big dichotomy between what you see in terms of the economic data, low unemployment, low jobless claims, and what people actually feel. And the polls continue to show this. So, the goal tonight for Biden is to convince the country that the economy is doing great under his administration and that we should elect him again come in November. That's the message he has to deliver tonight, because this is his one big chance to do that. So watch this tonight. It's going to be very interesting to watch. Again, there's lots of good economic data. You can't deny that. But underneath the surface, again, the vast majority of Americans don't really feel that because of the inflationary pressures, high cost of food, high cost of eating out. We've talked about all this stuff before. So just kind of a very interesting, but importantly, earnings growth, as I was saying, comes from economic growth. You can't have surging rates of earnings growth and have a weakening economic environment. Those two can't detach permanently, and that's where we are at the moment. Again, all we care about is, are we going to cut rates? Are we going to stimulate the economy? That's all great, but fundamentals ultimately do matter. Okay, so let's talk about what you need to know before the bell this morning. Again, as we said yesterday, this is kind of getting boring, but every day it's kind of been the same thing. Market's just trading in this very tight range. Came right off that 20-day moving average yesterday. We sold off on Tuesday. Bounced off of that yesterday. Had a very nice bounce coming right off that 20-day moving average. Again, we're not really kind of making any huge advance here, but again, just continuing to kind of just trade along this line. So every day it's just kind of this grind higher. And this is the dangerous part of the market. This is where complacency sets in. And again, if you take a look at investor attitudes, investor sentiment, and again, when you start going like, Lance, you just talked about this yesterday. I know, we've been talking about this every day for the last 3 weeks, because this is complacency, right? The market's just grinding higher every day. There's doesn't seem to be any risk to the downside. I was on Fox Business yesterday talking with Charles Payne. Same thing. He's like, hey, this market's just the can't stop, won't stop market. That's the attitude we always get when we get into these very complacent trends in the markets. And again, this was last year precisely that we were having the same exact conversation. If we go back to May, June, July of last year, we had this exact same conversation. This is the can't stop, won't stop market in a very defined trend running along the 20-day moving average. Everything is fine. It was all about AI. This was when Nvidia was surging off to the moon back then as well. And we were talking about the same problem because, again, you had this can't stop, won't stop market. The MACD signal was stuck at a very high level. It would trip back and forth a little bit, but wouldn't decline. We were at overbought levels for an extended period of time. Exactly the same situation that we have right now is exactly what was happening back last year, March, April, May, June, July. Of course, we were just coming off the bank crisis we had with Silicon Valley Bank. Then, of course, as we got into the summer, 10% correction. And that's where we're still set up today. We're still set up for a correction. Doesn't mean it'll start today, but again, at some point over the next several months, particularly heading into the election, expect to have about a 10% decline in your portfolio. That's going to come, and it's completely normal. There's nothing wrong with that. Just expect it to come, and it's going to hit the stocks that have been the high flyers. So again, you'll see a rotation in the market from these high flyers, the Nvidias, the AMDs, the CrowdStrikes, all these stocks that have been chased, the meme stocks. Those are going to get hit the hardest because the meme stocks in particular are the least liquid. So they'll get hit the hardest when we get this rotation. We'll have a big decline there. Money will rotate into more defensive sectors, and that'll help kind of, so think about defensive stocks in your portfolio right now. That'll give you some protection as you go through that correction coming up whenever it happens. But again, we could be talking about this environment that we're in at this moment, this complacent, trending, can't stop, won't stop market. We can be talking about this for a while longer because, again, back last year, we were having this conversation in June, and the market ran for another month before the correction eventually happened. So you need a trigger to get that correction to happen. We don't have that trigger right now, but it could be anything. Could be the Fed meeting coming up mid-month as well. So again, lots of stuff out there, but we'll talk about it. But that's what you need to know before the bell this morning. All right, we'll come back, pick up with Michael Liebowitz, talk a little bit about liquidity, because one of the issues that could trigger that sell-off is bank reserves. We'll talk about that when we come back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, talking a little bit about Nvidia, Cisco, and again, when we go back to the 1998, 1999, market, there are a lot of, and this is actually the subject of this weekend's newsletter, bubble or market top. There's certainly a lot of similarities in terms of sentiment and what's going on in the markets. And, and Mike will remember this, that, back in 1999, we had, lots of companies that were trading on kind of weird. We were making up metrics, right? Eyeballs per page, clicks per page. We were doing anything we could to justify why we were paying astronomical prices for companies that literally had no earnings. And this is one, and again, so when people want to compare a company like Nvidia to Cisco, there's certainly some decent comparisons. Like I said, in 1999, Cisco had a 50% market share. Everybody believed that the internet would have to run only on Cisco's routers. Cisco would dominate the space forever in Cisco routers. And then, first of all, once everybody bought their routers, well, there was this huge surge in demand, and then eventually that demand kind of waned as we just got into kind of replacement mode. We'd buy a router, and then we just have to replace it every now and then. But that huge demand to build out infrastructure was achieved fairly rapidly, and then sales tailored off. But then also we brought in other competitors. Other competitors, hey, I can build a router too. It's not a huge barrier to entry, and so other competitors showed up, built competitive routers, and today you have Euro and Cisco and just numerous types of routers that are out there to choose from, and all different price levels, and so Cisco's business has declined, and not in terms of decline, but their market share because of other competitors. But still, even because of that, the company's still growing earnings, but it's taken basically 23 years for investors to get back to even in Cisco. Nvidia, as a comparison, 75% market share, 75% margins. Everybody assumes that Nvidia will own that space forever, and this surge in revenue growth will continue forever. That's what you're betting on at 33, 34, 35 times earnings. And by the way, Cisco traded at 33 times earnings in 1999 as well. But just as a quick reference to this, as we were talking about all of these things, back in 1999, one of those companies was a company called Pets.com, and they actually had a whole sock puppet that went on, and believe it or not, Richard Rosso, and it always never surprised me that Richard Rosso has one of these in his closet somewhere. But this is probably worth actually some money now, on eBay. So I'm gonna go sell it. I'm gonna put this on eBay right after the show. He doesn't know this yet, but this is up for bid right after the show. So if you want your own Pets.com sock puppet, this is the original in the box still. What did this thing sell for? Is there a price tag on here? I have to. Yeah, but anyway, no Richard. He would actually buy one of these. But Mike remembers Mike, you remember this, right? You remember the Pets.com?
All the craziness. I remember all the craziness.
So
it was one after another.
It was. And of course, Pets.com failed during the .com crash, along with BlueMonkey.com and a whole variety of other companies that didn't really have a business model or earnings. But, this is just kind of the environment that we're in right now, Mike. And I was saying this during the opening, which is that, we don't even look at fundamentals. It was interesting. I posted that chart yesterday of Nvidia versus Cisco and talked about its market share. And, the comments were immediately, Nvidia is going to go up forever. It owns that space and nobody's ever going to be able to penetrate it. Or the other comment was, so you mean it's going to crash tomorrow? You're wrong. No, I'm not saying it's going to crash tomorrow, but right. Fundamentals matter, right?
Yeah, let me put some context around Nvidia and what it's worth now. I just stumbled across this morning. Nvidia is worth more. I'm going to go through a litany of companies here, and it's worth more than all of those combined. It's worth more than one of the world's largest telecommunication company, AT&T, the number 1 or 2 airplane maker, Boeing, the largest Coca-Cola soda distributor, Coca-Cola, the world's largest amusement park operator, plus movies, other things, Disney, the world's largest shippers, FedEx and UPS, a very large automaker, GM, General Motors, a large hardware, and now they're getting into AI too, company, IBM, largest fast food distributor, McDonald's, largest shoe company, sneaker company at least, Nike, largest coffee distributor, Starbucks, and Walmart. It's worth all of those companies combined.
Yeah. Which, and
pretty
again,
stunning.
It's a stunning. But the reason that investors are willing to pay this is because of the belief, A, that they're going to continue to grow earnings at the rate that they're growing earnings now. And B, I don't really care about that anyway, because all I care about is whether the Fed's going to cut rates or not, right? It's all about stimulus and bank reserves. Yeah. And, this is an interesting thing that's going on right now, Mike. So yesterday, Jerome Powell came out, had his speech, he's giving testimony to Congress and, talking about, rate cuts or potentially, kind of hinted at rate cuts are still on the table, although I don't think he really made a hard commitment to that for this year. We'll see. But bank reserves and repo are continuing to decline here, and bank reserves have not declined sharply yet. But the interesting thing is that bank reserves will eventually follow liquidity, and particularly the of what's happening with repo. And there is a correlation between bank reserves and what happens in the stock market. So in other words, if we start to see a fairly big decline in bank reserves, we should see a decline in the market itself because of that correlation between bank reserves. And again, we're not talking about a crash, but we're talking about reasons for a 10 or 15% correction in the market, which is completely normal. Could that come from this issue with the reverse repo and potentially a further drain on bank reserves?
Yeah, and bank reserves are reserves that they hold to make loans. So they can only have, given the number of reserves, they can only create so many loans. And we're talking about Nvidia, we're talking about speculation. This speculation is in part because mom and pop are buying a few shares of Nvidia, or we own on behalf of our clients a couple shares of Nvidia. This is because of large institutional speculation, which is driven by borrowing, by margin, by leverage. So, a hedge fund can put out $1 and buy $20 worth of Nvidia. And that's great. And that's what's going on. There's an incredible amount of leverage in the banking system, but much more so the financial system. But as soon as that leverage has to leave the system, it's always a problem. And that's why the Fed is kind of talking the way they're talking, right? I know they're not talking about cutting rates, but if you listen to Powell yesterday, he basically said our next move is a rate cut, probably at the end of the year or towards the end of the year. He is not even bringing up rate increases anymore. So you should ask yourself, why is he not being maybe a little more hawkish, right? We've seen interest rates come down, which is, on the margin, you can argue is a little bit inflationary. We've seen this kind of mania in certain sectors of the investment markets, right? Crypto is another signal that speculation is kind of going wild here, along with the Nvidias and a few other companies. So why isn't he more worried? And I think the answer is that liquidity is leaving the system quickly. And how do we know that? I'm going to share a chart here, Lance.
Yep.
Bear with me.
And this brings up, and by the way, this brings up a question too, but go ahead.
Okay. So on my screen here, and if you can't, if you're not watching out, does it work?
Yeah, absolutely. We got it.
Okay. This is the Fed reverse repo program. And this program was used to sop up excess liquidity in the markets. Had this program not been around, Fed funds would not have been as high as the Fed would have wanted it, because you have all this extra money that needs to be invested on a very short-term basis. And that extra demand for investment would push yields much lower than the Fed would have wanted them. So the Fed said, that's fine, invest in the Fed. Lend us the money overnight. We'll give you treasuries in exchange, so you're fully collateralized. And that's what happened. And you can see, if you're not at home, the graph goes up to about $2.5 trillion. It peaks right around the end of 2022. And it rose from almost zero to $2.5 trillion. So it's sopping up about $2.5 trillion. Ever since about the beginning of 2023, which is when the Fed started raising rates, which is when QT started, quantitative tightening, it's come down. And the Treasury has been issuing a lot of debt all along. So the market has to absorb the Fed's decline in their balance sheet. That's taking away some of the excess liquidity. And the Treasury is issuing a lot of debt, which is also taking away excess liquidity. And now, if you look at my graph, it's come down from $2.5 trillion to, it shows 500. It's actually closer to 400 because this is a week old. But the bottom line is it's heading to zero quickly. There's excess liquidity is being drained from the system, which means at some point, in the Fed's words, we get to ample liquidity.
So
good enough liquidity.
Right. So question on that topic, we'll come back from the break is that if liquidity is being drained from the system, how come financial conditions are so easy? Come back and talk about Michael Leibowitz right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I learned a very valuable lesson yesterday, Brett. You know, my wife had a really hard day at work, and she came home, and she was a little bit stressed out. And I said, well, honey, I'll take you to go get a scoop of ice cream. She said, no, I can't. I'm too fat. That's where I made my critical mistake.
The Real Investment Show podcast.
I said, okay.
Same show, your schedule.
Then I realized at that moment that I'd made this crucial mistake, which was I should have said, no, you need to get 2 scoops because you're too skinny.
At realinvestmentadvice.com.
You need some ice cream. Go eat a cheeseburger.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Just full disclosure, we are long Nvidia, AMD, Apple, Google, Microsoft. Some of these stocks that we talk about, we're long in our portfolios, just fair warning. And it's interesting because, as we're talking about Nvidia, there was a great headline out this morning on Yahoo Finance called Stocks on the Move. Nvidia. The stock rose 3% to close at a record high yesterday. The company's market cap is now north of $2.2 trillion, and Wednesday is another day that ends in Y. That is literally the line. So in other words, it just goes up every day. Actually, Nvidia just goes up on days ending in Y. So there you go. That's the gist of the headline. But that just kind of tells you where we are in the market. So, Mike, here's the question. It's a very interesting. I get this question a lot by email, so I just thought I'd just give it to you and let you answer it. It's a very interesting situation we've got going on. The Fed hiked interest rates, right? So we're now at 5.33 on the effective funds rate. So we've got higher interest rates, which makes things more expensive for people to borrow money, people to leverage, whatever they want to do in the markets. That's more expensive, more costly. The reverse repo market is draining, so that's removing liquidity. The the Treasury's issuing debt, removing liquidity. So we have all of these things that historically suggest we have less liquidity in the market, yet financial conditions are now easier than they were when the Fed was doing $120 billion a month in QE, zero interest rates, and we were just flooding the system with checks to households, you name it. How is it that we have easier financial conditions now with the Fed trying to tighten financial conditions?
So I think it's important to separate out what it's commonly referred to as financial conditions versus borrowing conditions. Financial conditions, and during a break, I pulled up the St. Louis Fed to get their definition. And what they say, and this is what's commonly, when we talk about financial conditions, this is a common measure, but I figured I'd go right to the source. Measures of equity prices, the strength of the dollar, market volatility, credit spreads, long-term interest rates, and other variables are basically financial conditions. So where equity prices, they're hitting new record highs just about every day. The dollar's kind of gone nowhere. Market volatility is about the lowest it's ever been in history. That's easy. That's considered an easy financial condition. Credit spreads, that's the difference between where corporations borrow, where those bonds trade, and treasuries. Those are about the tightest in history. Again, very easy financial conditions. Long-term interest rates are still very high, but they've been coming down for the last 6-9 months. So when you use that financial conditions index, yeah, it's easy. The stock market is going to the moon. Volatility is very low, as you typically see when stocks are rising quickly. And long-term rates coming down a little bit is certainly helping. And credit spreads are kind of doing what the stock market's doing, very similar. So financial conditions are great. That has to do with speculation. That has to do with sentiment, all of those things. But if you look at borrowing conditions, they're probably more important to the economy, not to the markets. The markets can deviate from the economy for long periods of time. Ultimately, they come back because earnings are what ultimately drives the stock price. But in moderate periods of times, there can be decent deviations. So if you look at consumer loan growth is now down to levels that we haven't, other than during the pandemic, is down below 3%, which is the lowest we've seen in about 10 years. Commercial and industrial loans, those are C&I loans, those are loans to corporations, are negative. And we haven't seen that other than a pandemic since 2008, 2009. So borrowing conditions the mortgage market is essentially shut down because nothing's happening in the market. So borrowing conditions and credit card loans are 21%. Auto loans are, even if you have the best credit, 7, 8, 9%. There are very few of those 1-2% auto loan deals. So borrowing conditions are not easy. They're very tight. And that's what the Fed manages. The Fed has trouble managing the stock market, credit spreads. They can do that through talk, but they can't do it through actions. And this is kind of what the Fed's dealing with. Their tool is working on loan growth, but it's, because they're talking about rate cuts, I'd say it's even making financial conditions easier.
Right.
So it's important to understand the difference between the two and what they mean and how they affect both the economy and the Fed.
Yeah, and this brings up an interesting question too about the Fed, because lately, economists have been fawning all over the Fed. They were all angry. They were all, very angry. I guess not angry, but disappointing the Fed for acting too late. With inflation and not hiking rates sooner. And now they're all fawning over Jerome Powell because the markets are doing great. The economy's doing fine, apparently. And, the Fed's hiked rates and Jerome Powell's right on track here. He's doing a great job and he's got everything right. And that's fine. But the problem that I see here is that the Fed has missed another opportunity, which they expanded their balance sheet dramatically during the pandemic crisis. And so, they were trying to bail out everything at that point. And now you've got this booming stock market. Everything, your interest rates are at 5.3. Nobody cares. The stock market's doing fantastic. You've got the financial conditions are super easy. Why would you not take this opportunity to really do QT, right, to a degree? I mean, we've been piddling at QT here to reduce the balance sheet a little bit. But why did they, why not just go ahead and aggressively use this opportunity of easy financial conditions to drastically reduce that balance sheet so you've got that available for when you do have the next recession? Or you do have the next, decline, and and we've had this conversation before. Why would you cut rates here if the market doesn't care where rates are? Why cut rates now? Right? Why start talking about cutting rates? If I was Jerome Powell, I'd be saying, "Hey, we're doing QT. We're going to keep doing this as long as everything's fine. We're going to keep doing QT. We're going to keep rates where they are because that's our ammo for the next recession."
Lance, first of all, I agree with you, and I've been on that same page. But if you're Jerome Powell and you know that there's a liquidity crisis coming in 2 months, in a month, in 3 months, whenever that excess liquidity goes away, what would you do? I think you have to start prepping the markets that you're going to add liquidity. So look, we can talk all day about the Fed mandates, price stability and maximum employment. That's what Congress told them they're supposed to be doing.
Right.
Doesn't matter. At the end of the day, the banks own them. Banks literally own the Fed. Jerome Powell's boss is banks, right? And the banks,
come on, let's be honest. His boss is Jamie Dimon. But other than that,
right. No, but the banks are what they're looking out for most, and banking system relies on financial stability. That relies on leverage, and they know that why are the markets up? There's still, I get it that the excess liquidity is declining, but there's too much money in the system. That's what that graph I showed you is showing you.
Yeah.
There's too much money in the system. It's not going to loans, right? The money could have easily gone to loans, could go to consumer loans, commercial loans, any kind of loans, and the stock market would be lower.
Right, but there's no reason where it is. But as a bank, why would I, if I have a prop desk, if I'm Jamie Dimon, but I've got a prop desk, why would I loan money to Brent where I run the risk of him not paying me back? Because the economic environment's not great, really. In reality, the economic environment's not great. Why would I take the risk on a loan to Brent at 3 or 4% when I can make twice that in the stock market?
Well, that's right. That's kind of the calculus going on.
Yeah.
And that's what banks have obviously decided, right?
Right.
Regardless whether that's the math or not, we know that they're lending money into the markets. So that's why financial conditions are very easy and there's excess liquidity. But I showed you that excess liquidity. And look, that's not going to nail it to the penny. Excess liquidity is exiting the system somewhat rapidly. And we know that. The Fed knows that.
So let me ask you a quick. We're about to hit a break, and I want to ask this one because I want to change topics when we come back. But if you're right, and the Fed is going, hey, I think there's a liquidity crisis coming in the next 2 or 3 months, why is the market not aware of that?
Is the market ever aware of a coming liquidity crisis?
Well, I mean, again, it seems to be
in 2019, it wasn't either.
Well, I know, but it seems like a fairly obvious event. You're right. In 2019, we had the same issue, and they didn't see it. But does that mean go ahead?
Maybe the street is selling to what they call the bag holders, to Main Street.
Right.
Maybe Wall Street is propping up stocks here to dump them onto Main Street.
Well,
that also, it would not be the first time that happened.
Well, and again, right now, institutions have been net sellers to retail buyers. So, and we've seen this consistent kind of selling by institutions over the last 2 months, despite this kind of rallying market. So you may be absolutely right in that point. All right, well, when we come back from the break, I do want to change gears just a little bit because we do have a Fed meeting coming up, and of course, that's going to be, pretty much kind of the same, I suspect. But, what about, the economy itself and, how this potentially impacts the actual economy? We'll talk about that with Mike Leibowitz when we come back from the break. Don't go away.
investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show today. Of course, it is the Real Investment Show. If you like listening to Michael Leibowitz here every Thursday, be sure and subscribe to the channel. We appreciate it. If you don't subscribe, he doesn't get to come back.
Promise.
So, all right, Mike. So kind of in the same vein, right? We're talking about all this liquidity issue, what's going on, and this reverse repo, this drain of reverse repo has been cross headlines. So we have that issue, right? And then if we go take a look at the economic data, it seems to be very strong on the surface, right? So again, if we take a look at unemployment claims, right? So unemployment remains low, jobless claims remains exceptionally low. Doesn't seem to be any real stress in the economy. The economy is still spinning off. It's going to be 2%-ish in the first quarter, down from 4.9 in the third quarter of last year, but still growing fairly strongly here. But yet, once we start digging into the data, right, whether it's the ADP report yesterday that came out, was a little bit weaker than expected, 140,000 jobs. But if we take a look at some of the actual data, where are we losing employment? Retail trade has been declining sharply. Transportation employment has been declining rather sharply. And so if you think about the fact that 70% of the economy is driven by the consumer, right? Retail trade, if I'm not hiring people for retail trade, that means I don't have a lot of demand there. And if I don't have a lot of need for transportation, my job openings for transportation are declining. And this all makes sense, right? So as the economy slows down, we have these fewer job openings that are coming. And so there certainly seems to be this dichotomy between the markets, liquidity, financial conditions, as we were saying, and what's happening in the underlying economy. And as we should all know, there is a correlation. Obviously, earnings have to eventually comply with what's happening in the actual economy. So, I mean, it seems to be a challenge here for the Fed to and especially with this meeting coming up in mid-month, it's going to be a challenge for the Fed to kind of navigate this. Thoughts?
Yeah, there's a lot of kind of odd statistics floating around there. And I think a lot of it is all because of the pandemic, the stimulus, stimulus, but it's not just the money. It's also behaviors. And one of the more fascinating facts that came out, like in a JOLTS report yesterday, was that the quit rate, so people quitting usually to find a new job, is now decently below where it peaked right before the pandemic. So when the quit rate is high, people are very aggressive. Like, I'm going to quit my job. I'm going to get a new, better job. It's wonderful, right? When the quit rate is low, they're concerned that they just want to hold on to their job. They're certainly not going to quit a job, right? So the quit rate is now decently low. It's below the pre-pandemic level. That's coming down. So people are not as hopeful about being able to get a new job. At the same time, the hiring rate is very low as well. So you have this whole dichotomy where the companies aren't hiring, people no longer feel like they have leverage, but there's no unemployment, right? No one's getting laid off. And I think that's because so many companies had struggled so hard to find employees that they're willing to let employees stay on, bad employees that aren't producing, because even if they're not really producing, they still need them. They still serve a purpose. Even if they work 20 hours a week and get paid for 40, the company can't really go on without them. So you have this, it's like the housing market. There's nothing going on in the housing market. There's nothing going on in the employment market. It's just kind of in this standstill, kind of waiting for something, I guess, to break. And it just shows up in all these numbers. That these numbers are strange. Some employment numbers are really good. But then you look at ADP, it's been growing in the low 100,000s now for 4 or 5 months in a row, which is, if that translated to the BLS, it's still growth, but it's subpar growth. But the BLS employment number has been above trend growth. So it's, I think between behaviors, between the wealthy driving a lot of numbers, that when you talk about all this data, like savings, because the savings rate may be high or low, that doesn't mean that it's low or high for everyone. A few people at the very top can skew that data. And I think things like that, along with everything else, is just skewing all this data, making it incredibly difficult to kind of figure out what's going on.
Yeah, and again, and this is going to be the challenge for the Fed, obviously, is that there's this demand on him by his bosses to cut rates, but yet at the same time, when you take a look at the economic growth side of the equation, again, and what are their two primary mandates? It's price stability and full employment. So you've got full employment, that's great, but price stability still a bit high here. And again, when you take a look at inflationary pressures on the household, now again, regardless of what CPI says, which has been coming down, has come down a lot, 9% to 3%. Food as a percentage of incomes, as we've talked about before, that's 30%. So, the household struggling with inflation at home, and obviously if you continue to have very robust economic growth, that's going to apply to inflation. That's going to keep inflation elevated, keep inflation more sticky. So the Fed's really kind of caught in this trap. If they start cutting rates, then that potentially fuels economic activity, which potentially boosts inflation. And now you're back in the trap. And so that's the real risk they run, right?
Yeah. And you know what? There's also, the behavioral aspect of everything going on is important, right? Because it's also driving some of this craziness. And someone told me the term a few days ago, Bougie Broke. And what that is a term for, I'm buying a lot of cool, fancy, luxurious stuff, but it's all on credit. I'm basically broke. But as long as I have a job, I can make the payments and I can keep all my bougie stuff and all is good. And I think there's a lot of that going on. People are traveling on credit, the buy now, pay later stuff. Everyone may be broke, but they have jobs. So they're not, default rates are rising on consumer debt, but it's not out of control. And that's all well and good. But A, it's limited. And B, when unemployment does start rising, whether that's this year or 5 years from now, that all falls apart. Bougie Broke becomes just broke because your bougie goes out on repo.
Exactly. Well, and it's interesting, everybody's looking to try to cut corners and reduce the highest cost of labor. in order to boost profit margins. And it's just interesting, while you were talking on CNN, the TSA is now launching a self-service screening for passengers in Vegas. So they're going to try it out there. But basically, you'll go and do your own screening to make sure you're not carrying any bombs or
Nope, no guns, no bombs.
Yeah, I guess you have to pat yourself down and, whatever else you want to do. But, the whole point of the screening is so if something flags, they take it over, they get the sniffer on it, and they make sure you're not carrying any, bombs or weapons onto an airplane. But, I'm sure everybody will be totally honest with their own self-service screening in Vegas. What could possibly go wrong, right? So, but again, it's this, at the same time that we're talking. And again, this is the same thing for companies. There is a long litany of companies that are laying off employees because employees are the highest cost of labor for any business. And, if I'm going to maintain my profitability, which is what Wall Street demands, right? I mean, if heaven forbid, if I miss by a penny when I report earnings, I've got to make sure I do that. So, we're seeing layoffs pick up across the board. They're not showing up in the numbers yet, but we've seen a lot of companies lay off 10, 15, 20% of their staff, particularly in the tech sector, just in the last several months.
Right. And where's the job growth coming from? A lot of it is coming from leisure, hospitality, restaurants.
Don't forget, government's been a huge hire.
And government.
Yeah.
Right. But all that leisure hospitality stuff, that's bougie spending. That's all nice. But when people start losing jobs, that spending goes away quickly.
Yeah, and no, it does. And I just, but, and again, we talked about this before, I can put bougie spending on my credit card, and now I can do bougie on my pay now, pay later programs, right? So I'm still waiting to see how that works out. This whole buy now, pay later scheme, whatever you want to call it, I'm waiting to see when that shoe drops, because we've never had this before. And there's a lot of companies like Affirm and others that have been doing great over the last few years because of, sending checks to households and all these other things. It's worked fine so far, but I'm interested to see when we get into an actual recession, how many of these companies are still around.
Yeah. I mean, it's like credit cards, but you have to pay them off. You can't just hold that loan forever like a credit card.
Yeah.
And that's what makes it a little different.
Yeah, the default rate could be exceptionally high on these buy now, pay later programs. So, all right, well, Mike, we're getting ready to wrap up the show. Any last comments for the day before we go watch Nvidia go up another 3%?
I really like the word bougie, if you haven't noticed. That's my thought of the day.
All right, thought of the day, bougie. Trust me, I have a bougie wife, so.
So do I, Lance. So do I.
They all are. Oh, and I have bougie daughters that go right along with it, so.
Preaching to the choir.
All right, buddy. All right, that wraps up the show for the day. Be sure to go by the website. Make sure and subscribe to the channel. We really do appreciate it. And again, we get our channel to grow, then that just allows us to do other stuff that we can for you. Be sure and get by our website as well. Michael Leibowitz's new article on Fed liquidity is on the website now about stuff we talked about today. But the actual article is there on the website, realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow. Financial Fitness Friday, Richard Rosso, Danny Ratliff, and of course, I'm sure Richard will be talking about his famous sock puppet tomorrow on the show as well. So have a great day. Enjoy your own sock puppet. We'll see you back here tomorrow.